There is another $10 billion reduction in the bond buying by the Federal Reserve. We have new forward guidance language in here. The 6.5% unemployment threshold has been replaced with, again, a more qualitative approach. The economy, the Fed says, slowed in the winter months, in part due, of course, to the inclement weather. Let me get to the forward guidance changes here with regard to interest rates in the future. That is arguably the most important message in here. Let me read directly from the statement. To support continued progress toward maximum employment and price stability, the committee today reaffirmed its view that a highly accommodative stance of monetary policy remains appropriate. In determining how long to maintain the current 0.25% target range for the federal funds rate, the committee will assess progress, both realized and expected, towards its objectives of maximum employment and 2% inflation. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations, and readings on financial developments. The committee continues to anticipate, based on its assessment of these factors, that it likely will be appropriate to maintain the current target range for the federal funds rate for a considerable time after the asset purchase program ends, especially if inflation remains in check. The statement goes on to say, when the committee decides to begin to remove policy accommodation, it will take a balanced approach consistent with its longer-run goals of maximum employment and inflation of 2%. The committee currently anticipates that even after employment and inflation are near mandate-consistent levels, economic conditions may for some time warrant keeping the target federal funds rate below levels the committee views as normal in the longer run. And in case anybody misses their message here, there's another line here, flat out says it. The unemployment rate nearing 6.5%. The committee has updated its forward guidance. The change in the committee's guidance does not indicate any change in the committee's policy intentions as set forth in its recent statement. So, a detailed explanation of the changes in forward guidance. The vote here, Mark, was not unanimous. We had one dissenting vote. It was Narayana Kocherlakota, who supported some of the forward guidance changes, but not all of them, saying that some of the language here weakens the credibility of the committee's commitment to return inflation to the 2% target from below and fosters policy uncertainty that hinders economic activity. So again, the vote was not unanimous here, and I mentioned at the top that the changes in the economy, again, during the winter months, growth in economic activity slowed during the winter months, in part reflecting adverse weather conditions. And just finally, Mark, let me talk to you about the summary of economic projections and the Fed funds rate projections that are also included being released at this time by the Federal Reserve. There are some modest changes in here with regard to both growth and unemployment from the 16 policymakers around the Fed table. Their summaries here. GDP now projected for 2014, the central tendency between 2.8 and 3%. That's down slightly. The top end before was 3.2%. We also have unemployment now for this year, 6.1 to 6.3%. That is down, of course, from where it was previously in December, 6.3 to 6.6%. And for 2015, growth now 3% to 3.2%. Unemployment 5.6 to 5.9%. And then, Mark, just to wrap this up, the Fed funds rate projections. When will the Fed begin to start to increase rates? 13 of 16 Fed policymakers now see the Fed doing that first move in 2015. One see it happening this year, two seeing it in 2016. And 11 of the 16 Fed policymakers surveyed here believe that the Fed funds rate will be at 1% or lower by the end of 2015. 5 see it above that, and 12 of the 16 Fed policymakers have the rate at 2% or higher by the end of 2016. So, Mark, the big change here, the one everyone expected, the changes in forward guidance, will they satisfy the markets? We'll have to wait and see. And again, one dissent from Narayana Kocherlakota.